I'm here at REITWeek in New York, and joining me today is Scott Craig. Scott is Vice President and Portfolio Manager with Eaton Vance. Thanks for joining us today, Scott.
Happy to be here.
After the run REIT shares have been on lately, it's natural for some to begin to worry that they're overvalued. What do you think of REIT share prices now?
I think it would be very difficult to argue that REITs are cheap. I think that they are valued at the higher end of a reasonable range. The implied cap rate for the index is now just below 6%, and the AFFO multiple is north of 20, and those are not metrics that make REITs look cheap. There are a few factors, I think, that make me not troubled by valuations. The first is that there's essentially no supply of any new product anywhere, just about. And so what that means is as the economy recovers, incremental demand will flow into existing properties, and that will help the cash flow growth. Second is, as best as I can gather, assets are not trading at meaningful premiums to replacement cost, and REITs are not trading at significant premiums to NAV. And that's always something that's important to look at. And the third thing I look at is, I think it's hard to find a better inflation hedge than REITs in the public markets. And so as people are increasingly concerned about inflation, I think REITs will be a good place for them to look for an inflation hedge.
So looking ahead at next year, what sector or sectors are you most bullish on?
Well, it would be hard to find anyone who doesn't believe apartments are going to have the best fundamentals. I think that's surely consensus, and I share that view. I think the interesting debate is whether or not that is fully baked into share prices. There is a debate there. Some believe apartments are overvalued and are giving too much credit to recovering fundamentals. I take the other side of that. I believe that apartment stock prices do not more than reflect the good fundamentals, and so I'm favorable on the apartment REIT sector.
So following the recession, have you altered the way you look at REITs or the way that you evaluate them?
I've always been relatively conservative when it comes to how I think REITs should structure their balance sheets. And following the recession, my conviction in that idea is firmer than ever. I think the recession demonstrated that low leverage is better than high leverage. And so I strongly prefer to invest in companies who have a conservative balance sheet philosophy. I think if you look at the REITs, many have learned what I think are the right lessons from the recession. You can look at some companies in the strip sector and the industrial sector for good examples. And I would highlight DDR as perhaps the single most improved company in my view as it relates to their philosophy about structuring the balance sheet and the metrics they look at to drive their business. I think if you look at before the recession and after, that's a company that really learned the right lessons from the recession, in my opinion.
Thank you so much for joining us today, Scott.
Thanks for the opportunity.
I'm Carissa Chappelle for REIT.com.